Welcome to Breaking News to Trading Moves. Today we're looking at a major transaction in the industrial sector that has really captured the attention of traders.
That's right. We're analyzing the agreement between AkzoNobel and Axalta. This is a combination valued around $25 billion, creating a real coatings giant.
Okay, let's get straight to the facts then. What does this new entity look like on paper?
Well, the combined group is set to have roughly $17 billion in annual revenue. That puts them in a very elite category.
And I see they have some ambitious internal targets too.
They do. They're aiming for a 20% profit margin and, this is the key part, about $600 million in cost savings, all driven by synergies.
Synergies can be a bit of a corporate buzzword. What does that actually mean here? Where do they find $600 million?
It's mostly from eliminating overlap. Think about it. They won't need two headquarters, two separate IT departments, two R&D programs running in parallel.
I see. So it's about streamlining everything.
Exactly. They consolidate manufacturing, get better pricing on raw materials, and cut down on general administrative costs. That's your $600 million right there.
Got it. So our job today is to review how this consolidation might affect stocks across coatings, chemicals, and industrial markets in the U.S.
When a deal like this lands, the market starts reevaluating everything almost instantly.
All right, so let's start with the immediate beneficiaries. Who are the primary winners in a deal like this?
Well, you start with the companies at the center of it all. You've got Axalta Coating Systems, that's AXTA, and AkzoNobel, which trades as an ADR under AKZOY.
So for Axalta shareholders, it's an immediate validation, a premium on their investment.
It is, but for AkzoNobel, what they're getting is scale and diversity.
Diversity in what way?
AkzoNobel has always been strong in marine and protective coatings, very technical stuff. Axalta, on the other hand, is a powerhouse in automotive coatings for both new cars, the OEM market, and the refinish market.
So they're filling in each other's gaps.
Precisely. It makes them stronger together, and investors are betting on that combined strength and the idea of a single, stronger global franchise listed on the NYSE.
Okay, that makes sense. But what about their direct competitors? I'm thinking of companies like PPG and Sherwin-Williams. Does a new giant on the block hurt them?
You know, you'd think so, but they actually benefit. This is what we call a sector re-rating. A transaction this size signals to investors that the whole industry is moving toward more consolidation.
So more discipline, better pricing power for everyone.
Exactly. It raises the floor. Investors look at Sherwin-Williams, that's SHW, and PPG Industries, PPG, and they think, well, if this new combined company is targeting 20% margins, the entire sector's profit potential just got a lift.
So a rising tide situation.
That's a good way to put it, driven by the prospect of higher, more sustainable margins for the whole group.
Okay, so let's look beyond the paint makers themselves. The impact here has to go further up the chain, right? What about their suppliers?
It does. You have to look upstream to the specialty chemical companies who provide all the raw materials, the resins, the solvents, the additives.
Right. If your buyer is bigger and more profitable, they have to be a better, more stable long-term customer.
That's the idea. They might negotiate harder on price, sure, but the volume and the stability they offer is huge.
And we're talking about companies like Dow.
Yes, companies like Dow, DOW, and Eastman Chemical, that's EMN. They supply the essential building blocks for these high-value coatings. A stronger buyer supports their volumes and gives them more confidence in their long-term order books.
So what does this all mean for the broader industrial sector? This kind of transaction reminds the market that big portfolio moves are still happening.
It's a bit of a sentiment lift, for sure. It tells investors that spin-offs and restructuring are actively on the table across chemicals and industrials.
And so people start looking for the next deal candidate.
That's it. You start to see attention turn to a company like DuPont and Nemours. DD DuPont has been actively managing its portfolio, and a deal like this signals there are buyers with capital out there. It also helps explain the lift for a name like RPM International, RPM, which some investors see as a potential acquisition target.
Okay, that seems to cover the winners pretty well. But now let's turn to the flip side. Who stands to lose, or at least feel some pressure from the creation of this massive new coatings provider?
The first group to feel that pressure is their large customers, specifically the auto manufacturers.
Why the auto sector in particular?
It's because of Axalta's strength in automotive OEM and refinish coatings. These products are highly specialized and they're not easy to swap out.
There's a long qualification process, I assume?
It takes years, not months. A car
Mm.
company can't just switch paint suppliers overnight. They have to do extensive testing. So when you combine Axalta's position with AkzoNobel's global scale, the merged company has considerable leverage.
So as those long-term contracts come up for renewal,
They can exercise more pricing power.
which means upward pressure on costs for the big automakers.
That's the expected pressure point for General Motors, GM, for Ford, that's F, and even for Tesla, TSLA. Their supply chains just aren't flexible enough to avoid it in the short term.
That's a clear challenge for them. What about the competitive landscape? What about the smaller players?
That's the second category of feeling the squeeze. The subscale players and niche specialists. It's just hard to compete with a larger rival that has a bigger research budget and can bundle products and services globally.
So it puts the pressure on their market share and their margins.
Absolutely. We see this affecting companies like H.B. Fuller, FUL, which is known for adhesives, and Quaker Houghton, KWR, a specialist in industrial fluids. They have to work much harder to compete against a leaner, massive rival.
Now, we mentioned RPM International earlier as a potential winner from M&A sentiment, but you're saying they're also on this side of the ledger.
Yes, and this is where it gets a little complex. RPM has a strong business in architectural and decorative coatings.
The kinds of products used in construction and building maintenance.
That's right. And this merger creates a tougher competitor in that exact space. So while investors might like the M&A story for RPM, the actual business now faces a leaner, more efficient rival.
So it's a competitive headwind for them.
It is. It could limit their ability to sustain their pricing power over time. And we see that same pressure affecting a company like Masco, MAS, which is also big in building products. They're now up against a much stronger, globally scaled competitor. So what we've reviewed here shows that a single merger, this combination of AkzoNobel and Axalta, creates pressures and opportunities that spread across multiple sectors.
It really gives you a framework, doesn't it? Understanding that one deal helps you form a perspective on companies from Dow, DOW, all the way to PPG and Masco.
And that raises an important question for you to think about. If this transaction is a signal of more consolidation to come in specialty chemicals, which other fragmented sectors might be next?
Thank you for joining us for this analysis. We must remind you that the content shared here is not financial advice or a recommendation to buy or sell any security. This is purely the opinion of the author of the material we reviewed.